In this first video, we want to talk about risk and return with respect to corporate finance. And really the topic isn't different depending on any other kind of discipline, but we do want to understand how risk affects the returns of projects and actions that management takes, and how the risk element is ultimately quantified or used. So in this example, we're going to talk about the fundamentals of risk and return, some procedures to measuring. We'll talk in basic terms about the concepts of diversification, how portfolio statistics are calculated. We'll also talk about the primary theory in corporate finance for bringing risk and return together, and that's called the capital asset pricing model. So that's the basics of where we're going to go in this chapter. There's two considerations whenever we make a financial decision. In fact, there is a theory in finance that's called the mean variance hypothesis. And essentially it says you can decide between any two assets as long as you know their risk and return. So in this case, we're going to be looking at the quantification of risk. There are different techniques for calculating risk and looking at risk, but we're going to be looking at it from two perspectives. We'll start looking at it from a single asset perspective, and then we'll switch and talk about a portfolio and how risk is affected when we create portfolios. So risk is a measure of uncertainty, right? It's a variability, if you will. It has to do with the unknown, right? Alternatively, when we calculate or quantify risk, there is actually a better definition, right? This better definition, as you'll see later, fits our formula for risk perfectly. And alternatively, risk is the chance, there's a probability that what you expect to receive, you do not. So you get something different. Now, sometimes this difference will be good, and sometimes this difference will be bad. Everybody understands what returns are, right? It's the cash, it's the change in pricing that happens when you invest in things. But there's two kinds of returns, if you will. There's a realized return, and this is the return you get by holding an asset but not selling the asset. So this might be referred to as a paper return. An expected return is just a return that, based on your analysis, it's what you think you will get moving forward in the future. So to calculate returns, essentially we're talking about a historical definition here. We have a basic formula. This is the textbook version here, but on this side, this is just an algebraic simplification. You take the cash flow and you add to that the ending price, P sub T. You divide that by the beginning price, which is PT minus 1. And then you subtract 1 from that. Now, this particular formula does not adjust for multi-period questions. So the spreadsheet, the worksheet that we'll look at, actually does both. What is the holding period return if you do not annualize? And then what is it if you take into account multiple periods of holding? So here's our example. Joe wants a lot, has two stocks. He's purchased 200 shares of each. He wants to determine, right, the return of the two stocks that he has owned, or that it says she, it should be he, that he has owned, right? So at the beginning of the year, Microsoft was trading at 73.10, and P&G was trading at 92.27. During the year, Microsoft paid $1.65 in dividends. P&G shareholders received $2.81. We then have ending prices. 106.08 for Microsoft and 80.88 excuse me, for P&G. So when we plug these into the mathematical formulas, of course, you see here you get 47% the return on Microsoft, and P&G was a negative 9%. If you plug it into our spreadsheet, our worksheet, this is the holding period return worksheet, HPR. Plug in the numbers, beginning, ending, cash flows, and time. So you can see here that the return, based on the formula here, is 47.37. But the HPR, as this worksheet designates it, is an annualized return. Now they turn out that it's the same number because it's 1 year. What would happen, do you think, if the time frame changed? What if the holding period was more than a year or less than a year? So on August 1st of 2013, Coors sold for $49.07. In these past years, a total of $7.86 has been paid to shareholders. And the current price on August 1st of 2018 was $67. So using the worksheet, again, if you have this worksheet open, we need to determine what is the return and what is the holding period return. Well, the beginning value is obviously 49.007. The ending value is 67.00. And the total cash flow is 786. What is the time of the investment? Well, you just take the year, 2018, and subtract the beginning year, 2013. So in this case, the time it took 5 years for this growth to happen. The return, when you get this, if you're looking at your the notes section of this PowerPoint, is 52.75, and the holding period is 8.8. So think about it. If you divide 52.75 by 5, right, you roughly have about 10%. And again, that's doesn't take into account time value, but it is a crude thing to way to estimate the HPR. But indeed, it's actually much lower than that. It's 8.842 is the holding period return that's calculated with this worksheet. So let's look at some real data. From 1900 to 2016, this is the data we get for some stocks. It turns out that the Treasury bills averaged about 3.8%, T-bonds 5.3%, and common stocks averaged 11.4%. So if you invested in just an average stock in 1900 to 2016, you'd earn about 11.4%. Now, the real term, right, the average real return is just the return is just the T-bill minus, or the rate of return, minus inflation. So in this case, they say that inflation must be in the ballpark of 2.9%. So 5.3 minus 2.9, again, some averaging out here is 2.5. And 11.4, again, averaging out here is about 8.4 is the real return. This is what you actually get in purchasing power once we adjust for inflation. We're going to discuss these other two statistics later on, but just safe to say right now, standard deviation measures risk, and the coefficient of variation is used to compare assets, so it gives us a relative measure of risk. And as you can see here, common stocks have a much higher risk level than what the other two assets have. Now, I've also done a little bit of research here, and you can see from my research, this comes from Ken French, who is famous for working on the risk-return relationship. you can see that he's divided stocks into small, medium, and large stocks. And he's looked at all stocks available. And if I'm not mistaken, the total number average stocks per year was in the ballpark of about 2,000 stocks per year. So a small stock, right? And his definition of small is, of all the stocks that he looked at, this is the bottom 30% in size. The bottom 30% average rate of return was 21%, the risk was 41%, and coefficient of variation 1.95. Go to the other extreme, large stocks over this time frame, and again it was 2016 to 2018, was 12.62, standard deviation 21, coefficient of variation 1.7. So real stock data over this time frame, even broken down by size, shows that risk and return are related to each other. The lower risk assets have lower returns. So hopefully we can utilize this kind of information as we think about how risk and return affect decision making. So if you think about risk preferences, right? How do people think about risk itself, right? What's the thought process that they have when they're thinking about it? Well, there's three ways. People can be risk neutral. And a person who's risk neutral basically doesn't consider risk at all. They are a return-only type of an investor. My example, this is kind of like a consumer, right? Consumers look for the benefits in assets. They're not always concerned with the badder parts or the things that are less attractive about an asset. They buy it for the benefit. They don't take into consideration other things. Risk seeking is a definition of gambling. This is when investors are willing to accept lower returns when risk goes up. And that, on the face of it, doesn't make any sense unless you think about gambling, which by definition, to be a gamble, it has to have a negative possible outcome, probable outcome, right? So, when you go to the casino, you really expect to lose. You don't expect to win. Risk averse is the way we think most people think, right? Most people recognize risk. They don't necessarily think risk is bad, but when they do see risk, they want to be compensated for risk. So a risk-averse person acts rationally when they see risk, they want to be paid for risk. So how do we measure and analyze risk? Again, the definition of risk is the chance that what you expect to receive doesn't happen. It's a measure of volatility and uncertainty. One of the ways that we can measure risk is through something called a scenario approach. We're going to create some different possible outcomes. We're going to predict them. There'll be a worst case, a best case, and an average case. And of course, we can increase the number of categories if we want. Now, there is a measure of risk that's called range. And range is just the worst possible outcome subtracted from the best possible outcome. Now, the only challenge with range is it really doesn't take into account the chance that those extremes happen. So range is a very rough measure of risk. Scenario analysis will allow us to more accurately calculate risk statistically. So we have a company, the Go for Gold Corporations, wants to buy one of two projects. Both projects cost $15,000, and given the scenarios below, we would like to calculate and determine what is the average rate of return on the projects and what are the statistics for the assets. So we have 5 different possible economic outcomes. So for A, it goes from 27% down to -5, And for asset B, it starts at 6% and goes down to 21%. So we want to now talk about the statistics that we're going to calculate. To calculate the expected return, there's two things we're going to look at. We have data that's historic. So if we have historical data, this is the formula. You add up all the returns in the database and subtract it by n. But in a scenario analysis, we have predicted returns, that's R sub I here, and we want to multiply each one of those returns by the probability that it will happen. Once we have added those or multiplied those all together, we then add or do a summation of all of these products. So the thing that's missing from our scenario so far is this concept of probability. We're going to have to estimate what we think those probabilities of occurrence are. And we're going to leave that for other courses, right? Potentially you could get this information in a statistics course of how to do this, or in an economics course, right? But there are other courses that can address how we calculate or how we determine what probabilities are. To calculate statistics for risk, we are going to ultimately look at something that's referred to as standard deviation. Standard deviation is the square root of another statistic called variance. But if you look in under this radical here for the square root, you see our definition of risk is very plain, right? The expected return is the average. That's what you expect to get. And in our example, there are returns for each event. So what is the difference between the return we are going to receive, what we expect to receive, and the average return? So this is the difference between what you expect to get and what you receive. Then we multiply that by the chance that that difference occurs. So this is very straightforward, the definition of risk. Now we also can calculate this for a sample, for an actual data set. And here we just subtract the returns from the average and square them. You sum those all up, divide it by n minus 1, and then you ultimately then take the square root, gives you standard deviation. The greater the number, the higher the risk. Now, coefficient of variation is a measure of risk. It's a relative measure of dispersion. Essentially, it takes the risk of the asset and divides it by the return. So how much return do you, how much risk do you take for every 1% rate of return? And of course, the higher the number, the greater the risk. Now, range is also available, right? That's also a statistic. That just tells us, takes the highest possible outcome minus the lowest possible outcome. So again, how do you predict probability? Maybe we survey economists. Maybe there's some techniques in some other classes that you might learn about. But let's assume, right, that we surveyed economists and we asked them to predict GDP in the next year. We get the count, right? They all predict. They say we sent out 200 surveys. They all replied. And we did a frequency distribution, and this is what the distribution looked like. When you convert the count to frequency, we have 10% chance very good, 5% chance very bad, etc. So what we're going to do with this information now is we're going to put this information into a worksheet. It's the standalone risk analysis worksheet. And again, here are the returns that we had in our example, and here are the probabilities that we just discussed. So now we can talk about the numbers. What's the average rate of return for these two assets? A averages 13.85 and B is 13.5. So B is a little bit lower return, obviously, than A. What about risk? If you look at risk, A is 7.74 and B is 4.12. So the question, or a question for an investor is, look, B is less risky than A, but the returns are very close, right? So is the increase in risk from 7.7 to 4.1, are we being compensated enough, right? So this is what, 3.6% more risk, and you only get 0.35% more in return. A very conservative investor might say, this is not enough bonus. This is not enough increase in return to make me to want to buy A, even though it obviously has a higher return. Coefficient of variation obviously shows that A is still a riskier asset. The range also shows that it's a riskier asset. So again, from a statistical component, right, we know what? A is riskier. In this case, it does have a higher rate of return, but we are a little bit suspect about the magnitude of that higher amount of return number. Let's think a little bit about historical data. Again, what I've done is I've gone out and I've gathered some data. Asset A here is Microsoft. Asset B is a 20-year treasury bill. And the market here, the final column, is the S&P 500. So we want to, again, calculate the statistics for this historical data. And I have a worksheet for this. It's called Historical Data Return. You input the price of the returns that you know in the columns, right? And then the statistics are calculated. So we see here that the actual return for Microsoft and the stock market are very close together. The stock market just a little bit higher. But look at the standard deviation. What you can see is the standard deviation for the stock is higher than it is for Microsoft. So we can get a little bit higher return, and we actually get less risk. So if you're thinking about which one of these to choose as an investment, if you could invest in the stock market, that might be a better investment opportunity because it has a higher return, although not by much, but it has a substantially less amount of risk. Again, if you look at the coefficient of variation, 4 compared to 3, the stock market has only about 75% of the relative risk that the Microsoft does. So again, this could help us make decisions as we go on. One of the things I just wanted to bring up, just so that we understand when we talk about probabilities and risk levels, right? The rate of return, the average rate of return is the mean. It's in the middle. If this is a normal distribution, we know that what? To the left of the average is 50%, and to the right is 50%. And again, I don't think it's important for you to understand the how these percentages are determined here. But if you do plus or minus one standard deviation, you have the mean plus or minus one standard deviation. That implies that there's a 68% chance that the actual return is going to be between these 2 points. Between -2 and +2, there's a 95% chance that they'll be in between those 2 points. And how we can understand this, or how we can put this into context, think about a stock that has a 10% rate of return. If this stock has a 10% rate of return and a 10% standard deviation, then there's a 68% chance that this stock will have a return somewhere between 0 and 20%. If you add them all together, right, this is all 50%, right, from the return over, that's 50% of the curve. And again, half of that is 34% here, right? So 34 plus 50 For this particular stock, it means that there is an 84% chance that this stock will have a return that's greater than 0. Again, that's the element of risk. What would happen if the standard deviation were 20? So now -1 implies that it's possible. There's a chance, right? 68% chance now that it's between -10 and 30, right? So we have expanded this range, right? There's a greater chance that what you expect to have won't happen because you have many more points in between. And that's really the concept of standard deviation. Standard deviation is a measurement of distance. And this distance equates to the numbers of opportunities that you can get a return. Of course, the calculation of risk, again, it's the chance that what you expect to get doesn't return. So that's the end of this first video on risk and return.